Okay, so on paper two, my goal is to get all the data to you by Friday. I was trying to automate it through Bloomberg, and there's just no way to do that. So I'll get the data to you. I do have a video on my YouTube channel on the Bloomberg playlist that shows you how to do what I'm doing. You really should teach yourself how to do it if you're in a dashboard team or you want to join it tomorrow. I show you how to get the data. You're using the ERN function or EE function in Bloomberg. Very, very effective. So I'll actually get that to you so you can see it. I may or may not give you returns. We'll see. I used to make students have to get the data themselves because you really need to learn how to use Bloomberg, but I've started doing it myself just so everybody has the same information. So it's an easier paper. You'll get a couple of weeks to write it. You can really write it in a few hours just sitting at a Bloomberg machine. So there's some pretty exciting ones to do. We look here recently. There's been some big news here recently. So today we get one of the GE spinoffs, right? GE split into those couple of companies and they both been doing wonderful. Danaher, a good healthcare company, Philip Morris, a good cigarette company, Verizon, telecommunications, Texas Instruments, a tech company. So you're seeing we got some big firms today. Nucor, good steel company. So we've had some interesting ones here recently. Last Friday, Friday's usually pretty soft and small, but you have Procter & Gamble, Schlumberger, got some banks. We definitely have banks. Banks have been doing great here this last earnings season. At Abbott Labs here recently, Morgan Stanley, a bunch of banks coming in. The problem with banks, and I may not do banks, but I want you to talk about gross and net margins. Banks do not have gross margins. Anybody know what banks have instead of gross margins? It has the word margin in it, but it's not gross margin. Any guesses on that? Have you heard of the net interest margin? So I probably won't do banks because of that. Banks are really interesting. Banks don't have free cash flows like other companies do. You probably have studied this in some of your classes. You haven't heard that before. I was just reading Damodaran's book. His little book on security valuation. He has a whole chapter on banks. He says on financial services, but then he completely ignores investment firms and life insurance and property casualty insurance companies. But what's interesting about banks and insurance companies is we usually think about cost of goods sold as being revenue minus, gross margin is revenue minus cost of goods sold. But banks and insurance company, their cost of debt is like a cost of goods sold. They're a spread business. So it's very, very different. You don't include debt. Debt's on the bottom line for most companies. For insurance companies and banks, debt's right there up in front and center. So what did they make on their auto loans versus what do they pay on their CDs? So it's banks may not work. You may really want to do a bank. That would be great. But banks are a little different. So I'll probably avoid doing banks. Netflix was big, right? We saw Netflix here. They're down today, but can you tell when their earnings were announced? Kind of stands out, doesn't it? Although I don't think it was on Friday. So when did they announce? So it says Thursday, but when did they really announce? Thursday after close or Thursday before close? The stock moved on Friday, so when do you think they announced? After close, and you can somewhat see that here. They got the little minus sign. So when you write your paper on Netflix, and Netflix will be one of the ones I'll give you, you're going to talk about the earnings coming out on Thursday, but you're going to talk about the stock, what it did on Friday. That's why it's real important, whether it's before open or after close. I think the majority are after close, although I'm seeing a lot that before. So that was a pretty big jump for them. So they must have had some good news. All-time highs, investment praise earnings. Netflix backs out of plan, develop block video games. You know, for Netflix, it's all about subscribers. So if you wrote a paper on Netflix, you'd be talking about their subscribers. So you might just separate it between the US and non-US. I don't know if the issue of them kicking out the shared accounts, is that a big deal now? Or has that bothered y'all at all? Y'all gotten used to that?
It's annoying.
It's annoying. So they lose customers because of that. They certainly got more revenue maybe out of that. Video games is a huge one. Sports is a big one. I'm really surprised ESPN hasn't figured out how to monetize that better because they're so hooked in. You know, what happens to cable TV if ESPN goes away? Does anyone have cable TV for any other reason besides ESPN? Isn't that the only reason you have cable TV? So that's death for them, but that's a big part of ESPN. But I would spend money on ESPN if I could watch college football. I don't know if I want to watch NFL, you know. It's kind of nice. Dallas usually disappoints in November, December. This year they moved it up, so I can save a lot of time watching those games. But I would watch I can watch any college football game. It can be 20 years ago, some two teams I never heard of. As long as it's close, I can watch it. But ESPN hasn't monetized that. So if Netflix gets into sporting, that's a massive amount of money, but it's also extremely expensive. You don't sell NFL games and spend a few $1,000s. It's going to cost you millions. Same thing with soccer and cricket and these other sports. They're expensive. So when you're looking at a Netflix, you're trying to look into the numbers and say, did this quarterly earning tell us something new about these big projects they have going on? And then you're going to see what management said, how the stock reacted. So obviously the stock market liked this report. The fact that it's off today, 1%, but they jumped quite a bit here. So, you're going to write your report entirely about that one day, that Friday. You're not going to look at what happened after that. You can talk about year to date, but you got to talk about that Friday. That's probably the biggest mistake students make is they talk about the wrong day or they talk about the whole year and don't talk about that day. If your boss is asking for this report, they want to know what that stock did on that day. Now, who might you compare Netflix to on that day? Oh, maybe Hulu. You can't really look at Hulu though, can you? Hulu's owned by a few. Have they spun off? Doesn't Disney have a majority in Hulu? You might look at Disney. And what did Disney do on that Friday? There's one where Disney react coincidentally or maybe worse. Who knows? They somewhat ignored it because it's a competitor, but it's not directly. So those kind of things you're going to write about, but you got to find some good articles. But there'll be good articles on Yahoo Finance. And then the news function in Bloomberg, you do the news function, you look for your company, look for the date. Not only will you find some good articles, but you can actually go into the AV function, which is the video part, and find really good videos. Really, that's probably the strongest. You'll see a portfolio manager talking about Netflix. That's the best. Remember, articles are written not by finance people, they're written by journalists. And a lot of journalists know very little about finance, although they're learning over time as they go, but they're not finance people. Your best insight is going to be analysts and what they say. I don't know if any of you are going to try doing the earnings call for your firm, if you can sit through that kind of boring hour, but that would be a good thing to do. Listen to your firm. So it's a huge business, Netflix, very, very impressive firm. All right, let me do attendance real quick. Everybody come back. Who's not here? First row's here. Second row. Everybody make it back. Third row. Looks pretty full. Fourth row. Raise your hand if you're not here. Back row, Bryce, Jalen. All right. Wow, we got 100% attendance. We should do a team exercise today. All right, so I'll get that to you by Friday. I'll do my best. So we want to finish up calculating returns. I want to do something. We may not get the risk today, but we're actually going to talk about risk today. I want to show y'all something that I hope you'll go away from this class and try it yourself. All right. I think this is really critical. So we'll try it today. And then calculating risk. So calculating return. The formulas you need is the holding period return. We talked about that. Ending value minus beginning value plus earnings divided by beginning value. So that's pretty simple. We usually do that monthly. And then what you're going to do is link them together. You can link them together arithmetically or geometrically. Geometric is the best when you're looking at history. Arithmetic is the best if you're building a model to go into the future. It's your best estimate going forward. How do you link them? Arithmetic's easy. If you have 3 months, you just add them together and divide by 3. You have 36 months, you add them together and divide by 36. That's really simple. Geometric, you have to pretend like you had $1 and you made that first year, the first month, and then you multiply that by what you made in the second month. You just multiply it. So it's multiplicative. You geometrically link them. It's a lot like the IRR. It's your actual true return historically. And then you raise it to the 1 over n minus 1. If you're not familiar with this formula, learn it because we use it massively in finance. I wish I knew how many times I've done this formula. It's got to be in the millions. I have spreadsheets where it's just thousands and thousands and thousands of that formula. It's very, very popular. Geometrically linked. It's also the way you can do CAGRs and other things. It's just an interesting way to try to get an annual return. It's your true return. So when you're looking at history, you really want to do geometric. To annualize them, arithmetic is really easy. If you're doing monthly, you multiply by 12. You're doing weekly, multiply by 52. If you're doing daily, it gets a little tricky. I usually multiply by 250. How many business days are there in a year? You can't multiply by 365 because we don't have weekends. Fridays are more volatile and Mondays are more volatile than Tuesday, Wednesday, Thursday, but not enough to explain those missing 2 days. It's true, we do get news on Saturday and Sunday, so it should make Monday and Friday a little more volatile while people are waiting for the news, especially Monday. But Monday's not so much more volatile that you can annualize by 365 days. Geometric, the way you annualize geometric is instead of taking it to the 1 over n, you take it to the 12 over n or the 52 over n. Okay, so let's practice that. I've got NVIDIA here. I brought NVIDIA numbers in back to 1999. Let's do 3 months just to practice what we did last class. So I'm going to do a holding period return for August, September, and October. No, I take that back. We can't do October because it is October. So let's do July. So the holding period return here is going to be the ending market value minus the beginning market value. Now I'm using the adjusted close. If I use the adjusted close, dividends are already in there. And remember, NVIDIA only pays a penny anyway, so it hardly even matters. So we can ignore the income. So we'll just do ending market value over beginning market value divided by beginning market value. What we'll do on Thursday is I'll show you an actual exam question that looks like this. And then on Tuesday, guess what we'll do? Team competition, right? So get some practice. So ending market value is going to be 117.01, beginning 123.52. We divide that by 123.52. And they lost 5%. Now, we know October, they just shot back. So we like to see October, right? They hit a new record high. I think they're back up above 3 billion, aren't they? They're really killing it. Which means they're probably about to crash again. Who knows? $3.5 trillion. They may be the biggest stock again, are they? Is anyone checked? Are they bigger than Apple now? 3.5 trillion. That's kind of a big number, isn't it? Boy, I don't know. What were they? 3, 5. I had to go out 3 decimal places. 3, 5, 8, 6. 3, 5, 2, 2. Wow, they're really close. So NVIDIA was the largest company in the US and the world for a few days there. Maybe not in the world. I don't know where the Saudi Arabia oil company is, but they may be getting back up there. I don't think Microsoft has done much. They're probably a laggard now. Yeah, they're way back there. But Microsoft been the largest company almost the entire year, and then Apple's taken over, and now NVIDIA is coming back. So those three just keep competing with each other. Do y'all know the entire US stock market was smaller than these companies back when I was in college? that the entire stock market was one of these companies. Isn't that pretty amazing? That's how much the markets have grown. It's just amazing. So they've definitely come back. If you look at October, what did I do? 143.59, and what are we looking at? 121. So they've shot back. So we're not looking at October, so they can look pretty bad. So if you're a little confused, so like I thought Nvidia was doing well, yeah, but we're stopping with September because we don't have all of October. So here for the next month is 119. I'm going to do it in Excel. Minus 117 divided by the 117. So they came back a little bit the next month. And then here you have 121 minus 119 divided by 119. So overall they lost. So how do we do the arithmetic average? You take minus 0.0527 plus 0.0201 plus 0.0173. On the exam, do everything in decimals. Don't do 5.27, 2.01, do everything in decimals. It works on arithmetic, but it doesn't work on geometric. It has to be the decimals. And then what do we divide by here? How many months do we have? 3, so you divide by 3, and their average monthly return is slightly down. Then if we want to annualize, what do? You take the arithmetic times what? Times 12. And then you're going to put a footnote. On the exam, you're going to put a footnote. Anybody know what the footnote says? It's in the class notes if you read them. I think I deleted it. No, there it is. Y'all see it? According to CFA, you're not allowed to annualize anything that's less than a year. So we put that footnote. If you go to Bloomberg and you put in 3 months, they will annualize it. They don't put a footnote, but they should. So according to CFA, you can't annualize. If you have 50 months, you can take the 50 months, divide by 50, and multiply that by 12, and that will give you a number you can use. But you're not allowed to do that in official documents. So CFA does not allow annualizing periods less than 1 year. All right. Why am I making you do it on an exam? Because I don't want anyone to see the exam and say, hey, your professor had you do something that you're not allowed to do. All right. I'm just protecting myself. Then the geometric average, a lot more work. Here we got to do 1 minus 0.0527, close parentheses, times 1 plus 0.0201, close parentheses, times 1 plus 0.0173. And I strongly recommend you do this on your calculator and practice it, because you have to make sure when we raise this to what? What are we going to raise this to? Someone yell it out.
1 divided by 3.
1 divided by 3 minus 1. You got to be real careful that the whole thing's raised to 1/3, not just that last parentheses. Okay, I'm not really sure how they do the order of operand here. Let's see. See, it doesn't work. So if you don't have the parentheses in the right place, you will get the wrong number. So if you don't put parentheses, it's only going to raise that 1 plus 1.073 to the 1/3. You got to raise the entire thing to that. So in the exam, you'll just write all that out. What I recommend that you could do is you could just do this piece and write it down. And then you raise that to the 1 divided by 3 minus 1. And then you raise that to the what? How do you annualize it? What divided by 3? 12 months divided by 3 minus 1. So there's There's the geometric average. And there's the annualized geometric average. And again, got to put your footnote. It applies to both of them. Now, what do we know about the geometric average? It must be lower than arithmetic average. That's not true for the annualized. The annualized can be higher, but for the monthly, the geometric has to be lower. Okay. We'll practice this again on Thursday with an actual exam question so you can see it, but really, really important. What's a lot more valuable here is to do this for an entire year. Let's start back here or for an entire period of time. So we'll do ending minus beginning divided by beginning. Unfortunately here, when Yahoo Finance, they used to let us dump the data, but they don't anymore. So I had to copy and paste this from their website. When you download it, it was 0.04321765. They actually went out many decimal places. Here they don't. They didn't actually make 0% that first month. It's just the roundings doing that. And that's just the nature. So we're gonna get some really, really bad numbers here at the beginning. So I'm gonna get rid of those months until we get to something a little more normal. Let's go through 2010. We'll go there. That one doesn't look good. No, that one's probably okay. It's probably a little exaggerated because when you have pennies, because that's the stock splits and the dividends, especially the stock splits, $100 stock now looks like 4 cents because they split it so many times. And so when you have 4 cents going to 4 cents, until they get to rounding to 5 cents, it doesn't move. So it's just an issue with the way Yahoo Finance is really irritating the way they're doing this. If I had access to Bloomberg, I could just dump it in from Bloomberg and we would have it. So there's our returns. How do you do with the arithmetic average? It's just equal average for that whole period. And there's their average. And how will we annualize that average? That times 12, 48%. Okay, so there's their average and annualized average. What about their geometric? Well, their geometric, you start with $1 and then you go $1 plus that. So the first month, your dollar drops to 81 cents. The next month, you start with 81 cents and you multiply that by 1 plus this. This is exactly what we're doing with the formula, the geometric length. You're starting with $1. Your first month, you lose 19 cents. The second month, you're back up to 86 cents. The next month, you're back up to 93, and then you're back in the hole again. Then you're way back in the hole again. Then you're way back. So your dollar has fallen all the way to 53 cents. So what kind of investor are you? Not too good. So what do? You go one more month. I'll give it one more month. Lost half of money, you get out. And then 2 more months later, you're starting to come back. Starting to look pretty good. But where did you get out? You got out there, right? Because you lost half your money. If you'd stayed in, you would have had to be 28 cents up. But then what do? You get out here. You say, wow, I could have stayed in. So you get back in here, and then what happens? You're back down again. Same thing again, a pretty volatile stock. We're still down 30 cents. That's what, 2 years in, we're still down 30 cents. We come down a few more years and you doubled your money. Come down a few more years, go into the to the COVID crisis, you're up $15. Come up to here, and that $1 that you invested is now worth $282. So just think, if you'd started with $1,000, you'd have $282,000 now. That sounds pretty good. Now it's over 14 years, but still, starting with 1,000 to 82,000, that's pretty good. If you'd started with 100,000, you'd be worth quite a bit of money. So how do we get this into a geometrically linked average? So we got to count how many periods there are. We've got 177 periods. So how do we get the geometrically linked? Anybody remember? Here's our geometric link. What did we raise it to? 1 divided by what? 177. And then what? Minus 1. It's going to be higher or lower than the arithmetic average. We don't have the arithmetic average in there anymore. So the for something, I don't remember. The geo, the 282 raised to 177 minus, I'm sorry, 1 divided by 177 minus 1. So it has to be lower. How much lower is it? Well, let's try it. The standard deviation. Did I go to the right one? Wrong one? I'm trying so hard not to hit escape. So that's part of my problem. Zoom is part of my problem. What did I do? Oh, I took 177 to 177. All right, 324. That does make more sense. All right, sorry about that. Yeah, you don't take the number of periods to the 1 over the number of periods. That's probably never going to be calculation for anything. Let's take the standard deviation. So what is geometric arithmetic? The formula should be the geo equals arith minus 0.5 times the standard deviation squared. Let's see if that gets us close. So we'll take, geo equals. So we'll take the arithmetic minus 0.5 times the standard deviation squared. How close did that get us? Pretty close. If NVIDIA stock was normally distributed, you should get right on there. So why is the geometric lower than the arithmetic? It's all because of standard deviation. Remember the thing we did where if you lose 50% and make 50%, the arith gives you a 0%, but you actually have lost money. So losing money hurts you more than gaining money. The geometric captures that, the arithmetic doesn't. It counts them equal. A gain is equal. All right. All right, we've got a few minutes here. Let's see if we can do this. So there are 4 formulas you should know off the top of your head as a finance major. You shouldn't have to look them up. You shouldn't have to use your calculator. You shouldn't have to use Bill Gates. So I might have done this in our class. Did I do it in our class last semester? I won't put Caleb on the spot. I might have. Luke, you remember? All right, so the 4 things you should know standard deviation from memory. You should know correlation from memory. You should know R squared, which is E from memory, and you should know beta. You should know these 4 formulas from memory. Anybody can do them. One thing that helps is the formulas are almost identical. These are the 4 most used formulas in finance. Now you use them in your stats class, right? Did your stat class make you memorize them, or you just gave them to you on the exam? So you shouldn't have formula sheets. You should know this. Why should you know it? Because there's a massive amount of finance in these formulas. To understand finance, you got to understand these formulas. So all 3 of them start with the exact same thing. They all start, anybody know?
The average minus
Close. Say the average second.
expected.
Not expected. You're on the right track. They all start with what's xi?
Initial.
Xi is each one of these returns. Each one of those is an xi. All right. What is x bar?
The average of all of them.
The average of all of them. All right. So all of them start with that. Okay. So you start off with the difference. Why is that so important? The entirety of finance on risk is how far you can get from the average. That's how we define risk. I bet your uncle doesn't find. Check with your uncle this Thanksgiving. I bet your uncle will talk about risk as losing money, don't you think? But we don't talk about risk as losing money. We talk about risk of how far you can get from the average. So your uncle, you put your uncle in NVIDIA, NVIDIA's up 20%, and you say, wow, that's really risky. Your uncle's like, what do you mean risky? I just made 20%. Why do we call something that's up 20% risky? If its average is 2%. Because we know if it can be 18% above its average, what else can it do? It can be 18% below its average. But your uncle doesn't think about that. I bet your uncle thinks risk is losing money. There is something called semivariance. You can look that up. That's what semivariance is. It only looks at risk when you're below the average. We don't use semivariance. We use standard deviation. If you go back to good old Markowitz, the Nobel Prize winner, he passed away this last year. He's the one who developed the efficient frontier. When he started the efficient frontier, he was going to use semivariance. But this was before computers and calculators. It was just too much work. So they went with standard deviation. But you could use semivariance says, how far below your expected value can you be? But standard deviation is how far above or below. The second thing you do, any guesses there? Yeah, you're going to multiply. Here, you're going to multiply this by itself. On standard deviation, you multiply it by itself. What happens to negative numbers when you square a number? They disappear. What also happens when you square something? Small numbers do what? They stay pretty small. Big numbers do what? They get really large. So there's two things that happens with squaring this. We eliminate negative numbers. We only care about the distance. We don't care if it's positive or negative. And outliers are going to be extremely important. Okay. For correlation, we don't square. Why do we do a correlation? We still multiply, but what do we multiply by? So for correlation, R squared and beta, we need two data sets. Right? For correlation, the second data set might be Y. So for correlation and R squared, because what is R squared? R squared is correlation squared. So it's the same formula. So here we have two data sets. Here what I have is NVIDIA and the stock market. Now this is very insightful. Can you have negative numbers here? Absolutely. What is the correlation telling you? When X is above its average, is Y also above its average? If X is below its average, is Y also below its average? If they're always above their average at the same time and below their average at the same time, what kind of correlation are you going to get?
Positive.
A very high positive number. If one's above when the other's below, and one's below when the other's above, what kind of number are you going to get? A negative, all right? So correlation is all about not how far from their mean they are, but when they're away from their mean, are they both above together or below together, or are they off? Diversification comes where? When one's above and the other one's below, or one's below, the other one's above. If they're both above and below at the same time, there's no diversification benefit, all right? But you still multiply. Beta does the same thing except for what? With beta, what is Y?
Risk-free rate?
Not risk-free rate. You're kind of on the right track. Beta is relative to what? Beta, we use Y is the market. So for beta, we have the company versus, so correlation, we could be doing NVIDIA versus Microsoft. We could do NVIDIA versus Apple. But for beta, we're doing NVIDIA versus the S&P 500, all right? But it's the exact same formula. Looks exactly the same. Why do we do third, do you think? By what? You take the average. Okay. That divided by N, or what did you learn in your stats class? Divided by N minus one, if it's the sample. In finance, we just use the population, all right? Don't use the N minus one, we use N. And either one, I mean, technically from a statistical, it depends on what kind of stats you're doing, but you can use this. So we're using the STDEVP In Excel, that's the population. If you do STDEV, you're using the sample one. But I always use the STDEVP in Excel. What do we do here? Exact same thing. We divide by N. Divide by N. Anyone know what this is called? I think y'all have stats. Has it been too long?
Sigma?
Not sigma. Starts with the same letter as correlation. Covariance, y'all remember that?
Yeah.
That's covariance. You notice correlation, R squared, and beta all use covariance in the formula. But you'll see how simple these formulas are. You start with the difference. You multiply the difference. For standard deviation, you multiply by itself because you only have one data set. For the others, you have two data sets you multiply. The only difference with beta is one of your data sets has to be the market. It's so simple. Then you just take an average. Really, really simple. And then what's the last thing you do? That's where it's all different. Standard deviation. I tell you that's variance, what would we do? Take the square root. What do we do with covariance? So we take covariance and divide it by the standard deviation of I. It's a standard deviation of Y. Correlation, it's just correlation. For R squared, it's just correlation squared. And the only last one we have is beta. Beta looks exactly like correlation with one exception. We're going to talk about beta here quite a bit. For beta, we only want the risk of the market. So guess what we do in the denominator for beta? Do you see the risk of the stock in there? It's right there. What do I mean you do here? It's got to be the market. All right. You should never have a formula sheet on these four formulas. You should just know them. You see how much finance is in these numbers. You can really understand standard deviation. It's measuring how far you are from the mean. Don't care if you're above or below. An outlier is going to be exaggerated. Correlation is how two things move relative there. People always say correlation is how two things move together, but that's not it at all. It's how two things move versus their means. Are they above or below? So two things could be up at the same time, but if one's up 4% and it means 1, and one's up 0.2%, it means 1. One's above its mean, one's below its mean. It's not whether they're up or down, it's whether they're above or below their mean. And then you multiply, you take the average, and then you do some things on the end that show you that the kind of theory here. Standard deviation can be any number. Correlation can be what? How low can correlation be? How low? -1, +1. What can R squared be? You're squaring correlation, so it can be 0 to 1. And what can beta be? -1 trillion to the trillion to a trillion to a trillion plus. There's no limit on beta. In fact, if I want a billion beta, I'll go out and find one of those pro shares S&P 3 times, and I'll buy a call option on it. I'm going to get a massive beta. All right. So beta is unlimited, but generally I think of betas as being from 0.4 to say 3.5, in my opinion, for normal situations. But the math, you can go anywhere. Walmart's beta has been negative for quite some time. Walmart has been a very good diversifying stock. It was positive in 2008. It did pretty well in the October 87 crash. So I generally think that's the range, but it can be any range. So what you should be able to do, and I don't know if I can do this in here. I'll start down here. wherever I started with. I'll do this quickly. So 2010, why don't we just change it to 2010? Bill Gates. Between Bill Gates and Zoom. I don't know which I'm going to sue, but one of them when I retire. All right, so we got to get the holding period returns. Here's our holding period returns. We do that. So I'm recommending you do this in Excel. We get the averages. Within the difference from the average. So we take each point minus the average. Each point minus the average. So there's the difference. What do we do next? We multiply for standard deviation. We just multiply each by itself, right? For the NVIDIA and for the market. For correlation, I've given up on avoiding the, I don't know what I did there. Okay. So deviation, we multiply, and for correlation and the others, we have to take difference times the difference. Then we do the average, standard deviation, correlation at all, the average on the standard deviation. Oh, I didn't do the S&P, sorry. Let me add one more here real quick. Yeah, I'm rushing for time. All right, I'll finish it up, but what you should be able to do in Excel is, without looking at formulas, you should be able to set up a firm with monthly returns and by hand calculate all these. I'll finish it up on Thursday and then check it. If you can't do that, I highly recommend you teach yourself how to do it. It's extremely important. All right, we'll stop there. Today, I've got some companies to show you for paper 2. We can talk about those, get you a little ready. I do want to finish up what we did last class, although I'm going to start kind of over a little from scratch to make sure you feel really comfortable with it. So for paper 2, here's the companies I've got so far. I'll definitely be adding Tesla today, but I can't do that until close. We'll see about Alphabet tomorrow. I might add a couple of more. I don't want the entire class to Tesla. I know that one's pretty big. From an interview standpoint, it's more impressive if you do a less known company, because everybody talks about Apple, Microsoft, and NVIDIA and Tesla. But if you do a firm like Schlumberger or ISRG, these are big firms. You know, at Netflix, everybody wants to do Netflix. But sometimes if you go on an interview, you can talk about, oh yeah, I was looking at so-and-so's earnings release. I mean, this sounds impressive that it's not one of these text, headline companies. But I've got the data in there. They're all linked. So if you want to do Levi, it's all set up. So you can look through and see which one you want to do. Let me walk you through what's here so you can see how you want to do it. So this is set up. If your boss would ask you to do this, exactly what would you do? So I'm preparing you for our first job. This is what, so your boss says, hey, so-and-so's earnings coming out, Tesla's earnings coming out, last night after close, give me a summary. So this is exactly what you want to do. So the way we do this, we start with earnings per share. This is in dollars. So you have three columns here. You have reported, you have the comparable, and you have the estimate. You can see there's a pretty big difference between the comp and the reported. That's not uncommon for a healthcare provider. United Health is a massive company. There's some massive companies in the healthcare side no one knows about because they're just in the background making a lot of money. And some of them are pretty questionable. CVS is pretty questionable. Pharmacy, medical provider, and a health insurance company. You're like, which one of those groups is ripping us off? You have to kind of worry about the incentives in healthcare. But the reported is the actual reported number in their GAAP financial statements. The comp, a better word for comp is adjusted GAAP. Some people call it normalized. So it's the number that has some unusual stuff out. What you'll notice, what do you notice about the comp versus reported as far as which one's larger? Comp is larger. Why is it the unusual stuff's always bad news? It's never good news. And there's probably some bias in that number. So it's a comparable or the adjusted number. So again, in your paper, you might say United Health reported $6.82 reported and earnings per share of 6.82, and then parentheses you say 7.15 after adjusting for whatever. That's the normal way it's done. And then the whole rest of the paper, you ignore the 682. The only time the 682 comes up is at the beginning. If they're both the same, all you have to do say is they reported this number. For most of these companies, they're the same, but not for everybody. All right. So the reported earnings per share of 682, 7.15 after adjusting for whatever the adjustment is. You actually see that in news articles. It'd be written just like that. So you can essentially take their explanation. If you can't find the adjustment, then do your best. If you absolutely cannot find any reason, then just go with the 7.15. The market doesn't care about the 682, so you can leave it out after you introduce it. Huh?
How do you find the adjustment?
Well, Bloomberg gives it to us. So you're going to use this file to do the paper.
Like, what did they adjust? Like, how did they get that?
It's all kinds of stuff. With Boeing, they may be adjusting for the strike. If they had some unusual payout they had to do, that was a one-time thing. Sometimes a firm will sell something like a major asset and there'd be like a $500 million unrealized loss or realized loss. Sometimes there's a major, like HP, they had to write down that purchase, so they had to write down all that goodwill. Those type of one-time adjustments. General Motors had a $16 billion adjustment they had to make because of the change in accounting for pension plans. That would have been in the reported, but not in their comparable. That 16 billion materially changed the earnings per share of the entire S&P 500. If you're looking at the PE ratio of the S&P 500, because PE ratios are off reported, not off a comparable. And so, like when GM reported that $16 billion write-off, it actually caused PE ratio to shoot up a little bit because it was an unusual adjustment. All right, so you're going to write your paper on the 7.15. You'll notice this 2.33% beat is off to 7.15. It's not off to 6.82. Now you might ask, whose comp is this? It is possible you'll get different comps depending on where you go. There are different people who have different assumptions. So what are you looking at? So this is the estimate. The market thought they were going to report 6.98 or 6.99. They actually reported 7.15, so they beat by 2.33%. Okay. All these other numbers in here you're going to ignore mostly. The other thing you're going to look at is the growth, and the growth again is going to be off the comp. So they beat estimates by 2.33%, and they're 9% higher than last year. Okay, so the numbers you're going to talk about are that one, that one, everything on this first row. And then this one. Now, Bloomberg does give the estimate all the way down, but I took it out because I had students, like if this was 6.24, I would have students talking about the 624. No one cares about the estimate from a year ago. It's completely nonsensical data. All right, so I just took it out, but when I copy it over, it brings all the estimates down, and I just took all the estimates out. So you wouldn't be tempted, okay? So the only thing you care about is the same time last year. We don't care about these any. Now, you can look at the intermediate numbers if you see something unusual. That's so, but because of seasonality, now you're thinking United Health, why would there be seasonality in United Health? Probably not, but still, we tend to go back a full year ago. All right. Questions on earnings per share? So United Health reported 682. Earnings per share of 682, 715 after adjusting for whatever. This beat the estimate of 699 by 2.33% and was 8.99% above last year. You could get away with not saying the 656 and just give me the 899, but you should give these three numbers. So this one's questionable if you have to give it. But all five of these numbers should be in your paper. Okay. If your boss is asking for this, they want to see all five of those numbers. The next thing you're going to talk about is revenue. The exact same thing, but what do you think? What do you notice about the comp number on revenue? Not much of an adjustment. You will occasionally see an adjustment on revenue, but it's pretty rare. So again, you're going to talk here. You can ignore that number entirely, and you can just talk these numbers. And if you want to, you can give that number. But they reported 100. Make sure you know if you're in billion. All of these companies are in billions on revenue. A few of them are in millions on earnings per EBITDA. So look real carefully to see. But they reported 100 billion, 820 million in revenue. This was higher than the 99.164 billion expected, or 1.67%. And it was a whopping 9% or 9.16% higher than last year.